Taxes, they're going to get you, especially the hidden ones.
The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Good afternoon, Wealth Advocates Nation. It's great to be back with you. We are here to talk about taxes. Many taxes you know about, some you don't know about, and our goal here is to get the government out of your retirement. So fortunately today, I'm here with the brilliant and beautiful John Mickelson. He's going to help guide us through some of these very complicated tax conversations. I say this almost every single time. I'm going to say it again right here. The tax code is 88,000 pages long, and it's all written in pencil, meaning Congress can change it at any time. So these are point-in-time facts as of 2025, as of the passing of the One Big Beautiful Bill Act. And we're going to talk about how this all impacts you. John, hidden taxes, you run across them very often?
Yes. In fact, most people are unaware that usually when there's cut in one place, there's an add someplace else.
Yeah.
And that's the hard part, is knowing how they coordinate together.
And I want to go through several different veins of taxes. Taxes that some people will know about, like income taxes. Others that they kind of know about, like there's a required minimum distribution out there somewhere. Capital gains, well, that's kind of moving. Sometimes it's 20%, sometimes it's 15%, sometimes it's zero. And I want to talk about Medicare and my favorite Aunt IRMA, IRMAA. Pay attention to that big word. And we want to talk about planning. So knock us out of here. Let's start talking about required minimum distributions. What are they?
Yeah. Okay. So the starting point with required distributions are traditional retirement plans were instituted to help us, encourage us, incent us to save for our own retirement and not rely on Social Security alone. So the basic premise of it is at some point the government wants their tax revenue. So that's where required distributions came into effect. Now, years ago, it began where you hit age 70 and a half.
Isn't that crazy?
So the year in which...
Trying to figure out, okay, so you were born in February.
Yeah.
Okay, so by August 15th, we've got to do that.
Yeah.
So then there was a mid-year, you were born in August.
Yeah.
Why do we do it now?
It was so funny to have to figure out, okay, when's the half point?
Yeah.
And that's really what it was. But you had to figure out, in what year do I turn 70 and a half? And in that year, I have to take a required distribution. Now, the requirement was look at the balance of your account at the beginning of the year, and then they had a table. It was a factor based on your life expectancy. How long are you going to live? And they made a percentage out of it. And so then you said, okay, it was like around 4%. Yeah. And you had to take out 4% or so of your, and it increases. Every year you get older, your life expectancy shortens, meaning I got to take a little teeny bit more and a little bit more and a little bit more. So they had this table that nobody knew what it was. We had to call in and have them calculate, here's the balance on January 1st, and here's the factor for your age this year. So it's a bit of a messy system. So then they complicated it further by saying, okay, it was 70 and a half. Now we're going to change that age. We're going to make it a little further out.
Yeah.
To the point where we are today, if you are born after 1960, you now have until age 75 before you have to start taking money out of those accounts. Now, for a lot of people, they're taking a systematic distribution to live on in their retirement. Many times that will satisfy what they're supposed to take. But if they don't satisfy what they're supposed to take, what's the effect?
Oh, man. Now we have a real problem. It's not as bad as it used to be.
It used to be 50%.
Huge penalty.
Yeah.
It used to be a 50% penalty, the highest tax in the land to our seniors who work so hard to save all this money. Yeah. Now, good news, it's only 25%.
And we still, as a matter of practice, set up an automatic distribution in December. If you forget to take your required distribution, we will likely send it to you no matter what. We do not want you to get hit with that tax and penalty.
What a waste of money.
Yeah.
Just to pay a penalty and then tax.
Yeah. And it's too easy to forget. It's too easy to say, I've taken some. Have I taken all of it? That's where we come in to try to make sure that you always satisfy what they're requiring. So the required distribution is kind of an important piece in your baseline income, along with your Social Security and other things.
Huge. So again, required minimum distribution. If you're taking it already, you're going to continue to take it.
Yeah.
Some of our clients start at age 73. So anybody born before 1960 is going to take it at 73. If they're born after 1960,
Then it's, of course, it's 75,
they're going to start taking
which is a
it at
nice
age
thing that we can
75.
wait longer. You're not forced into it as quickly.
If you think this is confusing, me too. I do this every year. So for every one of my clients, trying to figure out when do you hit one of these milestones, I send you a report at the beginning of the year because it is calculated off your January 1 IRA balances or 401k balances. And there are some exceptions to the rules. And then we send you notifications every few months. Hey, we haven't finished that required minimum distribution yet. Why? Because I don't want you to have to pay the IRS another 25% on top of the egregious amount you're already paying them.
And as a side note, remember that if you do any kind of charitable giving at all, you have what is called a qualified charitable distribution, QCD. What that is it says, hey, if, for example, you're taking a standard deduction, which many people are, that gives you no tax benefit if you give to charity out of cash, out of your pocket, because you're already getting the deduction through the standard deduction.
Right.
You don't get an additional deduction for the charitable giving that you do beyond that. So one of the benefits is if you use your required distribution, what you have to take out, transfer it to a charity, what would have gone to the government for taxes is now charitable donation. It goes to the charity. It does not go to the government.
Two birds, one stone.
Yeah.
I like that.
And allows you to do that up to $100,000 a year if you're over age 65. So if you're going to give to charity and you're already taking the standard deduction, don't do it from cash. Do it from your retirement account.
Really great. Really great. Okay, can I switch gears? I want to talk about capital gains. Capital gains is almost as complicated as required minimum distributions now. There are three brackets. There's the 0, there's the 15, there's the 20. I really want to tell you what those income amounts are, but I know you're going to listen to this at a different time. They'll
all change. Yeah.
So come in and see me. I have a printed out sheet of what it is this year, and I want this to be fresh data that's accurate. But a lot of times my clients they'll be working, they'll have income, they'll have Social Security maybe, and they'll sell something. And hopefully they sold it on day 366 plus, because that is called long-term capital gains. If I do it before that, short-term capital gains, that's the equivalent of income tax. We don't like that. So long-term capital gains, they may think I only have to pay the 15% because the income bracket today, which I'm not going to tell you what it is, it is pretty high up there. So we should be okay. But maybe they had a better income year than we expected. And it pushed them a little bit higher into the 20%. So there's a 5%. And maybe you're in the state of Utah and there's a 4.9%. Let's call that a 5% because I can do math faster that way. And then there's the Obamacare tax. That's 3.8. So if you thought you were getting 15, you bounced into the 20 plus the net investment income tax of 3.8 plus the state income tax. Holy cow, you just paid twice what you thought you're going to pay. So here's the ask is when we're doing a transaction, when there's something pending out there, let's do some tax projections. Now, I'm not a CPA. I'm not an accountant. I don't do your taxes, but I will project your taxes for you. And then the secret sauce at Wealth Advocates is we will coordinate with your attorney. We will coordinate with your accountant. We'll coordinate with all of your professionals because the coordinated estate increases your chances of financial success over just guessing. So that's our secret sauce is we'll coordinate your investment plan with your income plan, with your tax plan, with your estate plan, with your insurance plan. All 5 pillars of financial planning come together under one roof, and we make sure that you're winning at this game. And in that process, we're going to look at your income plan as part of this transaction that may be pending, and it could just be stocks. It could be a big farm. It could be all kinds of different things that are going to trigger capital gains, and we're going to do everything we can to get your 20% back into the 15% to eliminate the net income investment tax. And I can't really eliminate the state tax, but we're going to do what we can to give you an exact number, as exact as the numbers will allow us to project. So,
And there is logic, by the way, in saying at what point do we recognize even taxes at some level, because you don't want to hold an investment that is not a good investment because the tax makes sense. So there's a point where you have to coordinate the planning between all those elements to make sure that the logic doesn't get driven by what the government wants me to do.
Yep. Yeah.
So
there are certain incentives for every single transaction.
And there are cases where, for example, where people are at a 0% capital gains tax. I've actually run into that, and they have long-term gains in their portfolio. We can sell those at zero.
Great.
There are cases where that can be really a huge advantage to a client.
Really great. Really great. Now we need to talk about my Aunt Irma. I don't know why I call her my Aunt Irma, but it helps me remember that, oh yeah, there's a Medicare surcharge out there that is impacted by your income and your capital gains. IRMA stands for Income Related Monthly Adjusted Amount. It's a little bit more that you have to pay for your Medicare. So if you're in very, very low tax brackets, well, Medicare Part B and Part D, they don't really get impacted too much by it. But it can go up, and it can go up significantly. So we just need to pay attention to things like, is there a capital gains transaction? How much income are you getting from Social Security, from pension, from required minimum distributions or other distributions from an IRA, or from work? All those things post age 65 will push your IRMA penalty up. And I don't know how it goes down. I don't think it does go down. What they do is they look at your income, not this year, not last year, but 2 years ago. That's how the IRMA penalties figured out. So anybody that is finishing up their 2025 tax projection, which we're recording right now in 2025, we would go back to what was your income in 2023.
Yeah.
And that's what's going to determine what your Medicare surcharge is going to be. Do you have anything you want to add on IRMA? It's a complicated one.
No, but it does emphasize the point of saying you can't just look at 1 year in isolation. You really do have to be looking at how do we make this plan execute over time, over a series of years. Because the other thing is, as we get toward the end of the year, it's valuable to be able to say, we may want to wait long enough into the year to have a very good feel for how much income did you actually get based on different transactions or surprises that may have come up through the year.
And you are hitting on something that's just a great transition to my fourth concept I want to talk about, which is let's take a bigger approach to all planning, and especially tax planning. Tax planning is the one that we can impact the most, but what should we consider in the bigger plan, John?
Well, you have to consider what are my resources? Where are the resources going to come from? For example, Social Security, you're not going to refuse it. It is going to come in, and it is going to play into your taxes to some effect. Same thing with pension income. So you need to look at those baseline incomes, the different things that are going to come, and then plan around, how do I now build around that? If you have non-taxable sources in retirement, boy, that's a big advantage. Then you can say, okay, here are the ones I have no control over the taxes, the Social Security and the pension. I'm going to take those. And here's where the income comes in and how far I am into those tax brackets. Now, beyond that, do I have capacity to take additional income at a low enough bracket? If not, do I have tax-free resources, Roth IRA and the like? So all those things are going to be played into the coordinating, how do we do that, and how do we relate that to the tax plan and the CPA and other advisors that are going to be affected by it.
Really great. Really great. Okay, lots and lots of great data points on this. Let's just drive it home with a final takeaways. The first is Roth conversions are still a good idea. We want to get the government out of it. It's more complicated. Post the One Big Beautiful Bill. Watch our podcast on One Big Beautiful Bill. That's a helpful one. You need to map out your income every single year by age. Based on the data we have right now, the tax code's ever changing. It is written in pencil, but for what we know right now, we ought to make some forecasts to determine what your Social Security is going to be, when your pensions kick in, what happens if one of you passes away while the pensions kick in, when there's capital gains that we can project as we can, and what that might do to your overall tax picture. We want to watch for IRMA, my favorite Aunt Irma. We want to make sure that we know where those Medicare surcharge thresholds are. We want to look at our low income years. expenses, utilize them as best we can so we don't waste those low income years, and we could have converted a Roth IRA that year. And we want to look at the coordinated estate. We want to make sure that your investment plan matches your income plan, which will match your tax plan, your estate plan, and your insurance plan, all 5 pillars working together. John, any other takeaways that we missed?
No, just be logical in the fact that we've got all these different angles that we can use to kind of work to your favor and not work against you. In looking at it, I guess, in a messy way, it works against you. If you can see how they fit together, it really can make it very, very efficient. That's the most important thing, is how do we do it at a most efficient rate we possibly can.
Really great. Okay, that's it, Wealth Advocates Nation. Thank you for your time on this wrap up of many different ways hidden taxes can get us. We're watching for them. We want you to watch for them too. Time?
About 14.
Wealth Advocates is an SEC registered investment advisor. SEC registration does not constitute an endorsement of Wealth Advocates by the SEC, nor does it indicate that Wealth Advocates has attained a particular level of skill or ability. This material prepared by Wealth Advocates is for informational purposes only. It is not intended to serve as a substitute for personalized investment advice or as a recommendation or solicitation of any particular security, strategy, or investment product. Opinions expressed by Wealth Advocates are based on economic or market conditions at the time this material was written. Facts presented have been obtained by sources believed to be reliable. Wealth Advocates, however, cannot guarantee the accuracy or completeness of such information, and certain information presented here may have been condensed or summarized from its original source. Wealth Advocates does not provide tax or legal advice, and nothing contained in these materials should be taken as tax or legal advice. Please consult with your tax professional regarding your particular situation before implementing any strategies discussed. Advisory services are only offered to clients or prospective clients where Strategic Advocates and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Strategic Advocates unless a client service agreement is in place. Strategic Advocates LLC is a registered investment advisor. Please visit our websites at www.wealth-advocates.com or www.strati.co for important disclosures. Securities offered through registered representatives of Creative One Securities, a broker/dealer, member FINRA/SIPC. Advisory services offered through Strategic Advocates LLC, a registered investment advisor. Strategic Advocates LLC, Wealth Advocates, and Creative One Securities are separate entities. Wealth Advocates is located at 255 South Main Street, Suite 140, Logan, Utah, 84321.